Forex, stocks, and crypto represent three distinct arenas for financial trading, each with its own rhythm and rules of engagement. The foreign exchange market, or Forex, is a decentralized global marketplace where currencies are traded in pairs, operating 24 hours a day, 5 days a week. This continuous cycle begins in Sydney, moves through Tokyo, London, and finally New York, meaning you can react to global economic events almost instantly, but you also need to be aware that the market closes for the weekend. Its hallmark feature is high leverage, which allows traders to control large positions with a relatively small amount of capital, amplifying both potential profits and potential losses to a degree that can be unforgiving for the unprepared. In stark contrast, the stock market operates on a more traditional schedule, tied to the opening and closing bells of exchanges like the New York Stock Exchange or the Nasdaq. Trading happens during specific exchange hours, typically from 9:30 a.m. to 4 p.m. Eastern Time, and is closed on weekends and market holidays. This structure provides a natural period for analysis and reflection, but it also means that significant news released after the close will only be reflected in the next day's open, leaving you unable to act on it immediately. While leverage is available in stock trading, it is generally lower and more tightly regulated than in Forex, making it a more measured, long-term approach for many participants. Then there is the cryptocurrency market, the digital frontier that operates on a decentralized network of computers, which means it never sleeps. Crypto trades 24 hours a day, 7 days a week, and 365 days a year, offering unparalleled flexibility and constant market access. There is no closing bell and no weekend break, so the price of Bitcoin or Ethereum can swing dramatically at 3 a.m. on a Sunday. This perpetual open market, combined with its relative youth and lower liquidity in some assets, creates extreme volatility, where double-digit percentage moves in a single day are not uncommon, making it a high-octane environment for those with a high risk tolerance. The most fundamental difference boils down to what you are actually trading. In Forex, you are speculating on the economic health and interest rate differentials between two countries, trading one fiat currency against another, like the euro versus the US dollar. Stocks represent partial ownership in a real company, meaning your investment is tied to that company's earnings, innovation, and management decisions, giving you a claim on its future cash flows. Crypto, on the other hand, is often trading on the adoption and utility of a new technology protocol, with value derived primarily from supply and demand dynamics, network effects, and speculative sentiment, rather than any underlying cash flow or economic indicator. Liquidity and market depth also create a sharp divide between these options. Forex and major stock markets like the S&P 500 boast incredibly deep pools of liquidity, meaning you can usually enter or exit a position quickly without drastically affecting the price. This reduces the risk of slippage and makes price manipulation by large players more difficult. Crypto, while gaining liquidity, can still suffer from thin order books, particularly for smaller altcoins, where a single large sell order can cause the price to plummet. This can lead to wild price swings that are less predictable and more susceptible to whale activity. Your available time and lifestyle should heavily influence your choice. If you have a full-time job that demands your attention during the day, the Forex market's around-the-clock session, particularly its activity during the London and New York overlap, can be more accommodating. Crypto's 24/7 nature is even more flexible, allowing you to trade on your own schedule, but it also requires constant vigilance if you are an active trader, since you cannot rely on a market close to pause your risk. Stock trading, by its nature, confines your active involvement to the working day, which can be an advantage for maintaining work-life balance but a disadvantage if you want to react to overnight geopolitical events. Risk management is non-negotiable in all three, but the nature of the risk is different. Forex leverage is a double-edged sword that can wipe out your entire account quickly if you overextend, making stop-loss orders your best friend. Stock market risk is often lower on a trade-by-trade basis, but it includes gap risk where the price can jump past your stop-loss when the market reopens. Crypto presents the most extreme standalone volatility, but its market is also open, so you can place stop-losses that will generally trigger, though the sheer speed of a crash can still outpace your execution. In every arena, your psychological fortitude is tested, but the intensity and the speed of the test are wildly different. In the end, choose your battlefield based on your personality, your capital, and your time. If you are analytical, have a high-risk appetite, and enjoy fast-paced, leveraged action with nearly endless hours, Forex might be your arena. If you prefer analysis of business fundamentals, a more regulated environment, and a structured schedule that mirrors the corporate world, then stocks are your likely home. And if you are a technological optimist who thrives on extreme, continuous volatility and can handle high levels of uncertainty without flinching, the crypto market is calling your name. There is no universally best market, only the one that aligns with your skills, your risk tolerance, and your trading goals, so pick the battlefield where you have the highest chance of victory.